Welcome back to TaxCrunch. My name is Christopher Volis, and today I'd like to talk about how rental property affects your tax return. This topic generates some confusion because your participation level and overall income will affect how it's presented on your return. First off, for those of you renting out your home or vacation home for 2 weeks or less during the year, you don't have to report any activity on your return at all. It's one of the few circumstances that the IRS allows income to be completely omitted from a return, most likely because if you're renting it out that short of a time, you're probably not going to be showing rental profits anyway. For the rest of us with full-time rentals or more than 2 weeks in the year, all of your activity is required to be reported on the return. So let's begin with what is rental income. Anything you collect during the year, even if it's for future periods, is considered income in the year you collect it. Security deposits are not considered income until they're non-returnable. So if your tenant damages your property, you keep the security deposit, it becomes income in that year. Now keep in mind, you're also going to be able to deduct those expenses related to those repairs, so that should offset some of that income. If they cancel a lease, any buyout amount is considered income to you when you receive it. And if the tenant pays any of the expenses for you, for the property, that's considered income to you. However, you're entitled to deduct the expense as well, so it should be a wash. So those are the items that actually show up as rental receipts or income on your return. Now, what about expenses, otherwise known as write-offs?
What is that? Is that a new lamp?
Yeah, I'm thinking of bringing homeware into the store, so that's a write-off.
That's a write-off?
Yeah.
Do you even know what a write-off is?
Yeah. It's when you buy something for your business and the government pays you back for it.
Oh, and who pays for it?
Nobody. You write it off.
Who writes it off?
I don't know. The write-off people.
Common sense says anything paid for the benefit of the property is most likely going to pass the test. So easy ones are advertising for a tenant, commissions paid to an agent, insurance, real estate taxes, mortgage interest, utilities, supplies, things of that nature. You also can deduct travel expenses or mileage if the trip is for collecting rent or running errands for the property. And you can also deduct legal expenses, such as eviction expenses. For depreciating the cost of the property, you are going to get that expense each year, but spread out over 27.5 years.
That's not a write-off. That's not a write-off. This? Not a write-off.
Oh, well, the betting's non-refundable.
Now there's two other expenses, repairs and improvements. Now, what's the difference between the two? Think of repairs as an expense to fix something that's already on or in the property. So maintenance on a furnace, plumbing, roof repairs, painting, those type of items are all going to be expensed all at once in the year you pay for them. Now think of improvements as additions or items that prolong the life of the property. These are not expensed in 1 year, they're expensed over time, depending on what type of item it is. Some of these examples would be new roofing or appliances, windows, doors, wall-to-wall carpeting, and the labor paid for that work. So with COVID-19 affecting so many landlords in 2020, one item that is not deductible is lost rent. This is a topic that is confusing for people, but you can't write off something you don't pay for. So the opportunity lost from the rent is not a write-off for you. Showing less rental income is going to most likely cause a loss for you on the return, but you can't specifically write off lost rent.
A write-off is a business expense used to reduce your taxable income.
Okay, well then, why isn't it called a tax write-off?
It is! It is! You can't just buy things for yourself and write them off.
Now for how all this affects your tax return. If you end up showing rental profits, well, that's easy. You just pay ordinary income tax on the profit you make, whatever your tax bracket is. If you have rental losses, That's where it differs for certain people. If you're a real estate professional, this is your business, so you're entitled to deduct 100% of your losses in the year you actually incur them. However, in order to qualify as a real estate professional, you do have to pass 2 tests. The first one is relatively easy, and that is that you spend 750 hours a year, or about 15 hours a week, in the field of real estate. So a lot of owners can configure that time spent on their property or properties without a problem. The second test is where most people fail, and that is you have to spend over 50% of your time in real estate. So if you have a full-time job, you're going to fail that test. So it's really people that are ensconced in real estate all year round that are going to pass this real estate professional test and be able to deduct their losses instantly. So for the majority of property owners, your participation level would be considered passive. And to the IRS, passive losses are only deductible against other passive income. You wouldn't be able to deduct the loss in the year, however, you wouldn't lose it. It would get suspended into the future indefinitely. And you would get to use it in the future if you had passive income to go against it, or if you sold that property, at which time all your losses would get released into the calculation of the gain or the loss on that property. However, there is an exception to the passive loss rule. If you actively participate in the management of the property, you can deduct up to $25,000 if your income is below $100,000. If your income is between $100,000 and $150,000, that $25,000 deduction gets phased down to zero at $150,000. So anything over $150,000 in income, you can't deduct anything, and anything below $100,000, you get to deduct the full $25,000 if you have $25,000 of losses. If you exceed that figure, the amount that you exceed would get suspended into the future. So what qualifies as active participant? That's pretty easy. As long as you own 10% or more of the property and you make decisions on the management of the property, such as approving tenants or leases, things like that, you're going to qualify. Pretty much the only people that wouldn't qualify would be those that have management companies that do all the decisions for them. So hopefully this helps clarify how rental property might affect your personal tax return. Keep in mind, every taxpayer's return is unique and different. Therefore, general advice taken from family and friends, take with a grain of salt. Tax planning for your particular situation is always going to be the best policy. So thanks for tuning in, and I hope you stay tuned for more content from TaxCrunch.
Word to the wise. When you're speaking to somebody wise, you listen, you're cognizant of what they're saying. A wise person telling you. Anyway, just keep that in mind and keep up the good work.